Good evening, all. It's Sunday night. This is Shay Horowitz, ShogunTrading.com. Hope you had a great weekend. Hope you're ready for the next week. Stock market. S&P 500 has been in a sideways consolidation for quite a while now. This is a daily chart in S&P. I'll go into a 60-minute chart so we can see the last week or so, and you can see how basically all of June, and it's 2 weeks into June, we are sitting between the 924 and the 950 back and forth. We broke the 950 temporarily on Thursday, but then we closed below it, so it didn't really count. We really have to break the 950 on the long side with conviction before we can call this a breakout. Overall, we are still in a very tight, very slow, very gradual, very drifty type of uptrend in the stock market. This is not normal. It's not the normal type of market. Frankly, I've never seen this before. Not sure how long it's going to last, but we're going to have to watch it carefully. I want to go through a few more indexes real quick. Dow Jones Industrial Average looks basically the same. You can also see that it's also just drifting up, drifting up without any major trends. Not doing a whole lot. Let me see. We also have the NASDAQ 100 that had a little bit more momentum, but is basically stuck the same way that the other indexes are stuck right now. This is GLD. It's Gold Trust. It mimics the gold itself, and you can see that 100 is basically the 1,000 level, and we're backing off of it again. Let me switch over to weekly charts just so we can have a longer term look at these ETFs. So gold is reaching 1,000, but keeps backing off of it. Remember that 1,000 is inflation hedge. Silver had a bottom right around November of 2008. Remember, November 2008 was the election, so it's a very important time to remember. Since the elections, silver went from 9 up to 1550, which is quite significant. We called the bottom on the oil sector. Remember, the oil took a dive, right? July of 2008 took a dive from around the 100s down to the 30s. This is USO. It's an ETF that tracks the oil, and we called the bottom on it, and we gave you this trade. 33.21 was about our entry, and it's sitting right at 39.63. The oil can still go places. This is also inflationary. Bottom on that one was around February. This is the dollar. This is the dollar index. Overall currencies against the dollar basket, basically. And you can see how we came down, came down, formed a bottom over here, then came up, and now we're coming back down. Our dollar is coming back down. That's interesting. The bottom on this one was April of 2008. July of 2008, that's when the dollar started coming up. It reached peak in November of 2008 and March of 2008, and now it's backing off again. This is all really, really important. I'll summarize all of it in a minute. This is the XLF. This is the Financial Spider Fund, and you can see how it's banging against resistance right now. As a matter of fact, this is one ETF that we'll be looking to buy if the market breaks the 950. It's capable of moving pretty well. It went from 11 up to 13 last time, so it's got pretty good moves. But that's one that we would buy if the market starts moving. I'm going to cruise through a few more of them. Here's the home builders, and there's not much going on right now. They're actually looking a little weak again. The energy spiders are climbing up, but climbing up very, very slowly. This is the retail, and you see retail maybe a double top, possibly a change of direction is coming up on the retail sector. The industrial spider also looks a little weaker, hasn't really advanced its cause in a while. Materials, also the same thing. This is technology. Technology is coming up just a little bit, but coming up in a very chopping way, not a major uptrend at all. This one is interesting. This one is utilities. You can see utilities are coming up right now. Utilities are becoming more attractive. The yield on utilities is becoming more attractive. This is consumer staples, just drifting up slowly. This is healthcare, drifting up slowly, not doing anything of any significance whatsoever. This is metals and mining, and you can see how little by little this one is inching its way up. That's very interesting as well. This one is oil and gas exploration. You can see that we're trending up, but without much momentum at all. I'm going to go through some currencies. You can see these are basically against the dollar. Australian came up, British came up, Canadian came up, Euro came up, Swiss came up, Mexico fizzling, Swedish fizzling, and this one is the interesting one. This is the Japanese yen. Looks like the Japanese yen, once it breaks around the, I'm talking about these ETFs, once it breaks the $100 level, it could really take a dive. So that's definitely a currency to watch, a market to watch, is the Japanese yen. Russia, this is the market itself, and you can see that it's had a tremendous run off the bottom. But it's looking a little toppy right now, so we're gonna have to watch for that. And last but not least is the emerging markets. It's also had a tremendous run, but it's fizzling out. There's bonds. 1 to 3 year treasuries took a dive last couple of weeks. That's interesting because yields are coming up. IEF is the 7 to 10 year treasuries as well, and also took a dive. This is TLT. This is the 20-year plus, and I'm going to put it back on a weekly chart. And what I want you to see is, I want you to see the spike that we had in the treasury bonds when everybody wanted treasuries. Everybody wanted treasuries, and we had a tremendous spike, and now we're coming back down. This is the biggest part of the economy right now. The reason why is because if bond prices are going down, yields are coming up. We just had Treasury auction last week, and we paid out 3.99%, which was the highest percentage we've paid since last August. In other words, all of the money we're pumping into our economy, buying our own treasuries, is not having the desired effect. If bond prices are going up over 4%, over 5%, no one is going to loan out money on mortgage. If you're an investor, why would you let somebody borrow money to buy a house when you know you have risk with buying a house versus buying a treasury that's going to pay exactly the same? So that's why people that are lending money for mortgages are going to want a premium, and that's the reason why we saw mortgage rates coming up by a full point. That is trouble. We are seeing inflation coming up. We're seeing the market stalling. We're seeing we're seeing retail stalling, but the most scary part about it is that our treasury bonds are taking a dive. If we get our credit rating cut from AAA to AA, we're going to be in trouble because we're going to have to pay even more interest rates. Now, the more money we pay in interest rates, the higher mortgage rates go up, and the slower the recovery on our housing market will be. That is not the situation that the Treasury wants right now. So we have to pay attention to that very, very much this week. As far as trades for this week, I'll be looking at the financials. A lot of them are allowed to pay the TARP again. If they are able to pay the TARP, if they get released, if they break out, that could be a really, really interesting trade. If you want to take advantage of the financials, look at the XLF. Or the FAS, but the XLF I think is probably the best one. Now, through this market turbulence, through this market not going anywhere, and the S&P 500, I'll go back to it, and we'll go back into a 60-minute chart. Even though the market itself has not gone anywhere over the past couple of weeks, the trades are still there. The trades are still active, and that's where stock picking comes into play. USO, for example, we picked at 33.21, it went up to 40. TDC, we picked at 21.56, went up to the $24 level. OSK, we picked at 12, went all the way up to 15. CEDC, we picked at 25.66, went all the way up to the $32 level. NSR, we picked around the $20 level, went all the way up to the $22 level. And AK Steel, one that I gave you a couple weeks ago, $14.65, all the way up to the $21, $22 level. And last but not least, this was a quickie that we did on Thursday, $31.35, went all the way up to the $33, $34 level, $33 level, I think. But anyway, so what I'm saying by this is that the stock picks are still there. The stocks are still moving, even though the market is not. So you have to pay attention to both the indexes, but you also have to pay attention to individual sectors that are within the market. Watch those bonds, watch for the Feds to start acting, because they cannot keep interest rates down if bond yields go up. They're going to have to raise rates, which will not be good for what we're doing. You have to hedge yourself. You have to be in the market. You have to be active. Have a great week. If you need daily advice, that's what we're here for. Take care.